related number in the denominator. So why do we do this ratio analysis? Is ratio analysis helps you in determining the strength and weaknesses of the company. Okay, your normal financial statements like P&L, balance sheet, cash flow statement won't give out certain information. Some extra strengths and weaknesses you can find out with the help of a ratio analysis. That's the reason we do it. Okay. In examination, usually they have around 8 to 10 ratios. They take that help and usually frame the question. For the time being, quickly we will run through all the ratios, understand its meaning and calculation, then we will apply it. Okay. All right. First set of ratios that we need to know is the liquidity ratio. Under liquidity ratio, first one is current ratio. Current ratio is given by the formula current assets divided by current liability. Ideally, current ratio should be 2. This ratio is trying to calculate whether do we have enough current assets to pay off current liability. Do we have enough current assets to pay off current liability is what this ratio is trying to test. Next is quick ratio, or also known as asset test ratio. So asset test ratio or quick ratio is given by the formula quick assets divided by quick assets divided by current liability. So how do you calculate quick assets? Simple. Take the current assets. From current assets you reduce the inventory. If you have any prepaid expenses also you need to reduce, but in our majority of the problem prepaid expenses will not be there. So quick assets is given by current assets minus inventory. Because usually the thought process is inventory, we want quick assets. Inventory, can you sell quickly or it will take some time? It will take some time. Hence, from current assets, we eliminate inventory. If you do it, you will get quick assets. And this ratio is trying to test whether we have enough quick assets to settle current liabilities. So, ideal quick ratio should be 1. For 1 rupee current liability, you should have 1 rupee quick assets is what is the ideal number recommended. Alright. Next is cash ratio. Cash ratio is trying to test whether you have enough cash balance through which you can settle your current liability. Here cash refers to cash in hand as well as cash at bank as well as short-term investment. Numerator is cash in hand, cash at bank and short-term investments. Denominator is current liability. Okay, Zaru? Alright. Next is basics defense interval ratio. Basic defense interval ratio is trying to test if it's a doomsday. If it is doomsday, meaning if the company ka revenue stops, how many days can company survive? How many days can they meet their expenses? Let's assume that a whole year expense for a particular The company is 365 lakh. For the entire year, operating expense for the company is how much? 365 lakh. In a year, how many days are there? 365. That means how much is operating expense every day? Operating expense. Expense per day is 1 lakh, right? Operating expense per day is 1 lakh. Suppose company has cash balance of 25 lakh. Suppose company has a cash balance of 25 lakh. How many days can company survive if they don't get revenue? Sir, every day expenses how much? 1 lakh. How much cash the company has? 25 lakh. That means the business can survive for how many days? 25 days. Yes, people. Now express this in formula for me. How did you get this 25 days? 25 lakh divided by 1 lakh. What is that 25 lakh? Cash available. What is that 1 lakh? Operating expense per day. That's how you calculate basics difference interval ratio. So numerator is cash in hand, cash at bank plus short-term investment plus amount received from debtors, or rather debtors balance, divided by operating expense per day. If you do that, okay, so you will get something known as basics difference interval ratio. All right. Next is net working capital. All these are not very important, okay? Whatever ratio is important, you will get to know when we take up the questions. For now, quickly we are running through all the ratios, a quick revision, okay? So don't worry, there are more than 30 ratios, but only 8 to 9 or 8 to 10 are roughly tested in the examination in different ways, okay? These are just quick revision, that's all. Net working capital. So how do you get net working capital? Current assets minus current liability, okay? Next is capital structure ratio. All right, for under capital structure ratio, first ratio is equity ratio. So equity ratio is trying to test of your total capital employed, how much money has come through equity. Of your total money, how much money has come through equity. So this is given by the formula equity divided by capital employed. Equity here refers to equity share capital and retained earnings. Or rather, you can call it as reserves in surplus. In ratio problem, you will not have many reserves in surplus. Only one reserve you will have, that is retained earnings. Hence, you can call it as, so here the numerator will become what, sir? Equity share capital plus retained earnings or reserves in surplus divided by total capital employed. So this has many names. Equity share capital and reserves in surplus. Either you can call it as shareholders equity. Also, it is also known as net worth. Different names. The way of calculating is same. Equity share capital plus reserves in surplus, if you add, that number is also referred to as net worth. Capital employed ka another name is net assets. All this I've proved it to you with numbers. For now, we will just go ahead with the way the nomenclature is good enough. So capital employed ka another name is net assets. Okay, Saru? All right. Next ratio is trying to debt ratio. Debt ratio is trying to calculate out of the total capital employed, how much money has come through debt. So tell me the formula for debt ratio now. Debt ratio. Total debt divided by total assets. Capital employed. Meaning out of your capital employed, how much money has come through debt is what we are trying to test. When we say total debt, it means long-term debt as well as short-term debt. Divided by either you can call it as capital employed or capital employed ka another name is net assets. This is okay with you? So basically this ratio is trying to test of your money. It's like this. Okay, suppose you have taken a borrowings of your capital employed is 100 lakh. Your capital employed is 100 lakh. In that 100 lakh, 20 lakh has come through debt. So what percentage of money has come through debt? 20%. This is what debt ratio is trying to calculate. Understood everybody? That's all it is. Okay, I'll go for this. This is better. Okay, cool with this so far? Okay, next is debt to equity ratio. Debt to equity ratio is trying to measure the relationship between debt and equity. We already calculated in one of the problem, capital structure wala problem. How do you calculate debt equity ratio? Tell me. D divided by D plus equity, right? That was debt divided by debt plus equity, specifically that told. Here we are only trying to measure the relationship between debt to equity. That means the formula will be what? Numerator will be debt. Denominator will be equity. Equity ka calculation is equity share capital plus reserves and surplus, also known as net worth. Like that, okay? And debt here includes both long-term debt as well as short-term debt. But usually for all our problems, we only take long-term debt in the numerator. Okay, but as such, the ratio considers both long-term and short-term. But for question, we prefer to take long-term debt in the numerator divided by net worth or equity in the denominator. Any doubt so far, or can I move forward? So on. Can I move on? So on. I mean, everyone, cool? No? Okay. Next one is debt to total asset ratio. This ratio is trying to test, sir, to buy assets, we need money. To buy any assets, we need money. This ratio is trying to test how much assets has been purchased using debt. How much assets has been purchased using debt. The name only, there is a formula. Debt to total assets. Tell me the formula. What is the journal? What's in the numerator? Total debt divided by total assets. Total debt here includes both long-term as well as short-term. Total assets here include both fixed asset as well as current assets. Okay, G? Alright. Next one is capital gearing ratio. Little important ratio for examination. Of late 2-3 adjustments on this has been asked. Capital gearing ratio. What is capital gearing ratio trying to calculate is how much fixed cost instrument, listen to my sentence carefully, how much fixed cost instrument company is using to increase shareholders' equity. What did I say? Capital gearing ratio is trying to measure how much fixed cost instruments company is using to increase shareholders return or shareholders equity. Okay, stop, sir. Tell me, what is the breakup of capital employed? You know this? Capital employed means capital or total funds. Yesterday only we discussed capital structure problem. Capital employed means what, sir? How do you get capital employed? Equity share capital plus reserves and surplus. Only one reserves and surplus that usually we will have, that is what, sir? Usually only one reserves and surplus, that will be retained earnings. Plus, you can also raise the money through preference share capital. You can also raise the money through long-term debt. All this, if you add, you will get something called capital employed. Okay, Saru? Everyone cool? Now, capital gearing ratio is trying to measure, what did I say? How much fixed cost instrument company is using. Now, in this instrument, which has fixed cost? Can you tell me? On equity share capital, do you pay fixed rate of dividend? No. On reserves and surplus? No. These two are anyway linked. On preference share capital and long-term debt, you pay fixed cost? Yes, no. That means fixed cost instrument means what? Preference share capital and long-term debt. So, capital gearing ratio ka numerator is what? Preference share capital plus long-term debt. Okay. So, capital gearing ratio ka meaning is what? Using fixed cost instrument to increase shareholders equity. To increase shareholders equity. How do you calculate shareholders equity? Equity share capital plus reserves and surplus. Or you can also call that to be net worth. So, basically capital gearing ratio is given by the formula preference share capital plus long-term debt in the numerator divided by net worth in the denominator. Okay, sir. So, that's the way to calculate. Or how does fixed using fixed cost instrument increase shareholders equity is like this. Let us say, sir, okay, company first year they've generated a sales of 10 lakh. Okay, company has taken a debt. On that debt they have to pay interest in the first year. How much? 1 lakh. That means how much is profit before tax? 9 lakh. Let's assume that preference share capital is not there. Tax is also not there. Assumption. Tax is how much? 0. Preference share capital is also 0. That means this is PBT. PBT only becomes PAT. PAT only becomes E. So far good. Okay. So in the first year company has taken a debt. Okay. Now second year, now sir, bumper from 10 lakh sales became 60 lakh. Will interest change or interest same? On your bank loan, debentures and all, interest, if sales increases, you will pay more interest or same interest? So next year also interest will be same. Now look at Ish. How much is Ish? 59 lakh. First year it was 9. From 9 straight away jumped to 59 lakh. Why? Because on fixed cost instrument, do you pay more interest because of more sale or same interest? Same interest. By using fixed cost instrument, from 9 lakh each, it became 59 lakh each. This is what is capital gearing ratio. Okay, using fixed cost instrument to increase shareholders' equity. Meaning you don't need it. You need to know the calculation for examination. I hope this is okay so far, everybody. Can I move forward to the next one? Online also good. Early morning, woken up, people. Online, one other message aaki guru. It's okay. You can just walk in. That's absolutely okay. Anyone who comes a little late, just walk in. No problem. Okay. Next is proprietary ratio. Proprietary ratio is trying to calculate. Sir, you need to buy assets. We need money. Proprietary funds is trying to calculate how much proprietary funds is used to buy assets. How much proprietary funds is used to buy assets. So that means the numerator will be what, sir? Just like debt to total assets ratio, here it is proprietary fund ratio. Proprietary fund ratio is given by the formula proprietary funds divided by total assets. Sir, who is a proprietor? Proprietor means owner. Proprietors means obviously owners. For a company, who's owner? Only equity shareholders or also preference shareholders? Sir, shareholders are owners of the company. In company, how many types of shareholders are there? 2. Equity shareholders and preference shareholders. Now tell me how to calculate proprietors funds now. Equity share capital plus reserves and surplus. This belongs to equity shareholders plus what? Preference share capital. So if you do this, you'll automatically get proprietors funds. So basically the formula is proprietary funds divided by total assets. This ratio is trying to calculate how much proprietary funds is used to buy the total assets. So there is another way to calculate proprietary funds. I'll prove it to you in one of the problems. For now, I just call it out. Proprietary funds ka one way of calculating is equity share capital plus reserves and surplus plus preference share capital. Or another way is from the asset side. Asset side, what and all assets will come? Fixed assets and current assets. On the liability side, you will have long-term debt and current liability. Sir, current assets minus current liability, if you do, what you will get? Net working capital. So proprietary ratio is given by one more formula, fixed asset plus net working capital minus long-term debt if you have anything. This is another way because sometimes they give you this information, net working capital information in the question. Hence, to find proprietary funds, we may use this particular equation. I'll prove it to you with one of the balance sheet in the question. For now, don't have to worry. So there are 2 ways to calculate this proprietary funds. Even this is also little important for examination. Okay, Saru? All right. Next one is interest service coverage ratio. Interest service ratio, coverage ratio is given by the formula EBIT divided by interest. Okay, suppose company has EBIT of 10 lakh. Interest is 1 lakh. So do 10 lakh divided by 1 lakh, how much are you getting? 10. What this interest coverage ratio is trying to calculate is how much profit the company has to pay interest. How much profit the company has to pay interest. When you calculate it here, what did you get, sir? 10. That means what? Company has enough profits to pay 10 times the interest. Company has enough profit to pay 1 year interest or 10 year interest. Company has enough profit to pay 10 year interest. Now you tell me this coverage ratio should be on the lower side or higher side. Suppose you have given a loan to the company. You have given a loan to the company. On loan, how much interest you are collecting from the company? 1 lakh. Company has 10 lakh profit. You will be sad or happy? Happy, because you have to collect interest from the company only 1 lakh, and company has a profit of 10 lakh. That means company has enough profit to pay you 10 years interest. That means you will have a big smile on your face. That means everything going smooth. So this coverage ratio should always be on the higher side. Okay, Saru? Alright. Next is preference dividend coverage ratio. So the same lines, build the formula. What is interest coverage ratio ka formula? We want profit before paying interest. We want profit before paying interest. That only we call it as EBIT divided by interest. Similarly, preference dividend coverage ratio. Sir, using EBIT, can you pay preference dividend? No. From EBIT, you have to reduce interest. You will get what? Earnings before tax. Can you use EBT and pay dividend, or first you have to pay tax? From EBT, reduce tax. You will get what? Earnings after tax. Now, earnings after tax, can you use for preference dividend? Yes. So, instead of EBIT, the numerator will become what, sir? Earnings after tax divided by interest of preference dividend. Since we are calculating preference dividend coverage ratio, the formula will be profit after tax or earnings after tax divided by preference dividend. Done. Okay. Similarly, you can also calculate equity dividend coverage ratio. Tell me, equity dividend coverage ratio. Can we use earnings after tax to pay equity dividend? No. From earnings after tax, first you have to reduce what? Preference dividend. Then you will get what? Each. Is each available for dividend declaration? Yes. That means the numerator will become what? Each. Divided by denominator, that is equity dividend. That way you will get equity dividend ka coverage ratio. Even coverage ratios are sometimes asked in the examination. Okay, even coverage ratio could be taken as important. Alright, this is not required, it's okay. Alright. Next is turnover ratio. Sir, turnover ratios are important for examination. Okay, we have 5 to 6 turnover ratio. At least 1 or 2 will definitely come in your most of your ratio question. At least 1 turnover ratio usually will be given. More than 1 usually, but at least 1 will turn up. Okay, turnover ratio, or also known as efficiency ratio. Right? These are trying to measure the efficiency of the organization. How efficiently company is using their assets, how efficiently company is using their capital, etc., etc. That is what efficiency ratio or performance ratio is trying to measure. Okay. All right. First turnover ratio is, name is what, sir? Total asset turnover ratio. Sir, in the name only there is formula. Don't look at the formula. You tell me the formula here. Total asset turnover ratio. So that means looking at that line, what should be the numerator? What should be the denominator? Looking at this word, first asset is coming, then turnover is coming. So ideally, what should be the formula? Assets are divided by turnover. Ideally, the formula should be asset divided by turnover. Okay. Sir, let us say we have invested in assets worth 10 lakh. Company has purchased assets worth 10 lakh. Using, sir, if we buy laptop and all, if Arivu Pro, if we invest in laptop or iPad or AC and all, what will we use this for? To conduct classes. When we conduct class, what will we get? Money. Yes, revenue. Let us say we generated a revenue of 15 lakh rupees. We generated a revenue of 15 lakh. Calculate this number. How much are you getting? 10 lakh divided by 15 lakh. Quickly tell. 10.67. Correct? Okay. Now you tell me, sir. You have generated how much? How much you're getting? 0.67. Sir, you tell me, am I using, if this is a scenario for Arivu Pro, okay, are we using our assets efficiently or not efficiently? Sir, we invested 10 lakh in our assets. From our assets, how much revenue are we generating every year? 15 lakh. I mean, this is bad scenario or good scenario? Good scenario, but you are getting 0.67. That means if you calculate like this, it looks like this. You have invested 1 rupee. This efficiency ratio is trying to calculate how efficiently have you using your assets. Okay. If you do this, you are getting 0.67 means it leads to an indication that if you invest 1 rupee in assets, if you invest 1 rupee in assets, you are getting generating a revenue of 0.67. For 1 rupee investment in asset, you are generating a revenue of 0.67. Is that the scenario or ulta? Sir, I am invested only 10 lakh in my asset and I am generating how much revenue? 15 lakh. That means, should this be the formula? No. Actual formula should be what, sir? Do the ulta. It's not assets divided by turnover. Take it as what? Turnover divided by total assets. That is a formula. If you recalculate this, how much it will be, sir? If you take turnover divided by assets, how much you will get? 15 lakh divided by 10 lakh, that will get you how much? 1.5. And this is good. Yes or no? Because I have invested 1 rupee in my assets. If I invest 1 rupee in my assets, how much revenue will I generate? 1.5. So that is what we are trying to measure. Hence, or a quick way to remember the turnover ratio is, whenever they ask you turnover ratio, always take turnover or sales in the numerator and other component in the denominator if you get confused. Or one quick easy way to remember it. For any turnover ratio, the sales should come in the numerator and the other component should come in the denominator. So if it is asset turnover ratio, the formula will be sales divided by assets. Sales divided by assets. Sir, suppose sales information, if it is not given in the information, the next best information you will use is COGS. Sales is always the first priority. If sales is missing, then you will take the second priority item, which is COGS. Okay. Similarly, in denominator, company will buy the assets only one day, only once in a year, or they will buy throughout. That means you tell me. And revenue also company will generate one day or throughout. Hence the denominator should be what, sir? Ideally the denominator should be average assets. Because assets will not be purchased once. Asset will be purchased throughout. Hence the denominator ka first priority is average assets. So to calculate average asset, you should know one information or two information. Two. What is that two information? You need to know opening balance of asset and closing balance of assets. Suppose they don't give you opening balance, they only give you closing balance. Means, can we calculate average? If average information is missing, then you will take a closing balance of assets in the denominator. This is how to calculate. First priority for average asset. If you are not able to calculate the average, then you will take the closing balance of asset as a denominator. That's how to calculate the turnover ratio. Done, everybody? Can I move forward to the next one? Okay, next one is, okay, one if you have got, other 2, 3 you will tell for me. Fixed asset turnover ratio. Tell me, sir. Fixed asset turnover ratio. Formula you tell. Sales divided by fixed assets. Okay, first priority in the numerator is sales. Sales missing means COGS. Denominator ka first priority is average fixed asset. If average is missing means closing balance of fixed assets you take. Same ground. Okay, this ratio is trying to calculate how efficiently company is using their fixed assets. Okay, if they invest 1 rupee in fixed asset, how much revenue that company is able to generate. That's what this ratio is trying to calculate. Move on to the next one. Okay, next one is capital turnover ratio. Tell me the formula. Capital turnover ratio given by the formula sales divided by capital employed. Okay, first priority for sales. Sales missing means you will take capital. Sales missing means you will take COGS. Denominator mein you will take capital employed. Usually average capital employed will not be given. Hence you will take closing balance of capital employed. Capital employed ka another name is also net assets. That also can be taken. Alright, next is working capital turnover ratio given by the formula. In fact, capital turnover ratio is trying to measure how efficiently company is utilizing their money. Because to run the business we need money. Correct? No. Now for us to open this Coimbatore branch we needed money. Now, how efficiently did we use that money is what we are trying to measure in capital turnover ratio. Okay, that's all it is. By using their capital, how much revenue the company is able to generate. Similarly, working capital turnover ratio is given by the formula what? Sales divided by working capital. First priority for sales, next priority for COGS. If COGS sales is missing, then only you will take COGS divided by denominator working capital. Move on to the next one. Okay, next is inventory turnover ratio. Inventory turnover ratio, for class purpose, we'll call it as ITR. Tell me the formula again. Don't look at the screen. Inventory turnover ratio given by the formula. Ideal formula. What is your mind saying? Sales. So divided by average stock. Oh, if average stock is missing, you'll take closing stock, right? But hang on. Sir, is inventory measured? You know, you have studied basics of accounts at least. Although accounts comes in your group 1. You have studied. Inventories are measured at selling price or cost price? Cost price. That means for inventory, first priority should be sales or COGS? COGS. That means the numerator for inventory turnover ratio is first priority always for COGS. If COGS information, if it is not given, then you will use the next best information, which is sales. Divided by average stock if information is available. Otherwise, you will take a closing stock. Move on, people. Alright. Suppose inventory turnover ratio is 6. We calculated inventory turnover ratio and we got it to be 6. What it means is, alright, how many times, if inventory turnover ratio is 6, that indicates that company is able to sell their inventory 6 times in a year. Company is able to sell their inventory 6 times in a year. So we want inventory turnover ratio and all to be on the higher side. Okay. Now using inventory turnover ratio, you can calculate something known as inventory velocity. Using turnover ratio, we can always calculate another number called inventory velocity. Or forget about that formula. Just take the help of this. Inventory turnover ratio is how much? In my example, 6. What it means? What it means? Company is able to sell their inventory 6 times a year. That means on an average, for how many months is company holding their inventory in their company? On an average, company is holding their inventory in their factory for 2 months. How? Sir, 6 times in a year if you are able to sell means how many months are there in a year? 12 months. So 12 divided by 6 you do. How much you going to get? 12 divided by 6 is how much? 2. On an average, company is holding their stock for 2 months. Okay, that way you will be able to sell the inventory 6 times. This only is what we call it as inventory velocity or inventory holding period. Tell me the formula now. How did you calculate? How did you calculate 2? You tell me. You took 12 divided by 6. What is that 12? Number of months in a year. That's your numerator. Divided by 6. What is that 6? Inventory turnover ratio. Tell me the inventory ka velocity ka formula once again. Numerator is, or you tell me this one only. Either it is 12. Sometimes they may give the data in months. Sometimes they can also give it in weeks or in days. That means the numerator will either be 12, 365 or 52 divided by inventory turnover ratio. That way you will get inventory ka velocity. Okay, people. Inventory velocity simply means on an average, for how many months is the company holding on to their stocks? They're keeping the stocks in their factory for how many months? That's what inventory velocity is trying to calculate. Move on. Correct. Okay. Next is debtors turnover ratio. And tell me the formula, sir. Debtors turnover ratio. Formula is what? Sales divided by average debtors. 1 second, hang on. Is debtor, see, ratio analysis means can you take random number or related numbers? Related numbers. Sir, is debtors associated with the total sales or credit sales? I mean, what should be your numerator? Credit sales divided by average debtors. If average is missing means you will take a closing balance of debtors. Okay, people? And moreover, here debtors, no, it's actually not debtors, it is accounts receivable. It is accounts receivable. Accounts receivable means debtors and bill receivable put together. But in majority of the problem, bill receivable data will not be given. That's the reason we say the formula credit sales divided by debtors. But actually, it's better to say the formula to be credit sales divided by average accounts receivable. Because in some problem, they will give you BR. They'll give you bill receivable. So that way you should be a little careful. One problem, I'll take it up on this adjustment also. Done, sir? Okay. Sir, using debtors turnover ratio. Okay, let's take like this. Let's say we calculated debtor turnover ratio and we got it to be 4. We got it to be 4. What does it mean? What does it mean? We are able to collect from your debtors, you will collect money. If debtors turnover ratio is 4 means in a year, we are able to collect money from debtors 4 times. We are able to collect money from our debtors 4 times. That means how much credit period am I giving to my debtors? That only we call it as debtors velocity. Tell, how did you calculate inventory velocity? 12, 365, 52 divided by ITR. Debtors velocity, how do you calculate? 12, 365 or 52 depending on the data divided by debtors turnover ratio, which is DTR. 12 by DTR if you do, you will get debtors velocity. Debtor velocity is nothing but your average collection period. So or credit period. So if you calculate here, you are getting how many months? 12 divided by 4 if you do, you will get 3 months. So on an average, you are giving a credit to the customers for a period of 3 months like this. So one information if they give, this is also important. these data, as I told, every turnover ratio from ratio is very important. They will use one or two, definitely will come in the questions. Which one will come? Difficult to say. Almost everything has been tested previously. So that's the reason you can keep everything as important. Okay, next one. Sir, payable turnover ratio. Tell me the formula, sir. Payable turnover ratio. Sir, now you will take sales. Sir, it is payable turnover ratio. Payable means creditor. Is creditor linked with sales? No. That means what you should take. Should you take sales in the numerator or purchases? That too, you should take full purchases or creditors associated with credit purchases. Credit purchases. So numerator will be what? Annual credit purchases divided by average accounts payable or closing balance of accounts payable. Okay. Accounts payable means creditors and bills payable put together. In majority of the problem, bills payable may not be there. But if it is there, you have to be a little careful. Okay, Saru? This is your payable turnover ratio. Same payable turnover ratio. If you get it as, if you get the payable turnover ratio as 6, that means what? If PTR is 6, if you calculate payable turnover ratio and if you get it as 6, what it means? In a year, we are paying the creditor on average 6 times a year. We are paying the creditor how many? 6 times a year we are paying. That means, can you calculate payable velocity for me? Payable velocity, can you calculate? How do you calculate velocity? Velocity means holding period or credit period. How do you calculate that? 12, 52 or 365 divided by payable turnover ratio. Okay. Usually the data will be given in months. Usually. So assuming that this data is given in months, 12 divided by 6 if you do, how much you going to get? 2 months. So on an average, we get how much credit period from our creditors? 2 months. That's all this ratio is trying to calculate. Okay, this is done. Need a breather or next? Easy? Okay. Next one is profitability ratio. First one is GP ratio. GP ratio, this and all you already know. GP ratio is given by the formula GP upon sales into 100. Net profit ratio given by the formula net profit divided by sales into 100. Operating profit ratio. Operating profit only we call it as EBIT. Operating profit ratio is given by the formula EBIT upon sales into 100. So should we have to remember ratio formula, sir? Absolutely yes. Don't even ask any question. Should we remember this or that? Okay, you have taken one course called CA where they will test you everything. Your memory, your application, your skill set. All the things are tested. Okay, so goes without saying you have to remember everything. It will not be. The formula will not be given. You have to remember it. Okay, next one. Alright. See, cost of goods, COGS ratio. COGS ratio is given by the formula. It's basically trying to calculate what percentage of sales constitutes COGS. So given by the formula COGS upon sales into 100. Next, operating expense ratio. Sir, administrative expenses, selling and distribution expenses is referred to as operating expense. So operating expense ratio is given by the formula. Numerator it will be administrative expenses plus selling and distribution overheads divided by sales into 100. Okay, this is one. Then watch out for this. This is operating expense ratio. Next, they give you something called operating ratio. This is important. Operating ratio. Sir, to run a business, will you incur only operating expenses or you will have to also incur direct costs like COGS? COGS is also required. Operating expenses also required. Operating ratio is given by the formula to generate revenue. Totally, how much operating expenses I have to incur? To generate revenue, what is the total operating expense you need to incur? To generate operating expenses, you will have to incur only indirect cost or even direct cost also. Direct cost. Direct cost we captured in COGS. So tell me operating ratio ka formula. COGS plus operating expense divided by sales into 100. That way, if you do, you will get something known as operating ratio. Okay, people? Okay, sir, you know this formula. From another way, from sales, if you reduce COGS, what are you going to get? And this another way of presentation. From sales, if you reduce COGS, you will get gross profit. From gross profit, if you reduce operating expense, you get something called EBIT. Another way of representing income statement. Yes or no? Correct? Correct. Okay. Sir. These two put together becomes your COGS and operating expense totally becomes your total operating expense. Okay. From sales, if you reduce the total operating expense, automatically what are you going to get? EBIT. Yes, no, people? From sales, if you reduce COGS and if you reduce operating expense, automatically what are you going to get? EBIT. Okay. Indirectly, what I'm trying to say, sir, if they say in the question, this is a popular adjustment once it has come in examination. Sir, if operating ratio is 85%, if operating ratio is not operating expense ratio, if operating ratio is 85%, what it means? Operating expense means total operating expense. Operating expense, how do you calculate operating expense? Tell me. COGS plus operating expense will be equal to what, sir? 85% of sales. That's what this ratio is trying to calculate. If operating ratio is 85%, means indirectly we are trying to say COGS plus operating expense is 85% of sales. Sir, from sales, if you reduce COGS and operating expense, what will you get? EBIT. Sales is 100%. If these two put together are 85%, means indirectly what, sir? EBIT is 15% of sale. This is a good adjustment, has been asked 1 or 2 times already. Yes, everybody? So if operating ratio is 85%, means in 100 mein se minus 85 you do. 100 minus 85 is how much? 15. So if operating ratio is 85% of sales, means EBIT will be 15% of sale. We will apply this also in one of the question. But I hope it is making sense till now. Correct, G? Okay, move on, G. Financial expense wala ratio, not that important. Given with the formula, financial expenses divided by sales into 100. Financial expense means your interest. On your debentures, you have to pay interest. On bank loans, you have to pay interest. All that only is referred to as financial expense. Not that important, so it's okay. Alright, moving along. So next 1 or 2 more ratios are there. Quickly we will review that and then we will dive into the question. Sir, after this ratio, I will give you probably a breakfast break. We will take a break and then we will take up the next topic. Today will be an early break, in case you're wondering. Okay. All right. Next is something known as return, profitability ratio on overall return. Return on investment. Return on investment. So there are 3 returns on investment. 3 types of return on investment. One is ROAS, which you're already comfortable with. Another one is return on equity. Another one is return on assets. Any of the return on investment, all these 3 put together or return, all these 3 only we call it as return on investment, or rather return on investment are of 3 types: ROAS, ROE as in ROE, and ROA, ROA, return on assets. ROAS, you tell me, sir, you know the formula for ROAS. ROAS, EBIT, return on capital employed. ROAS is given with the formula EBIT divided by capital employed into 100. Sometimes they tell you in the problem, calculate ROAS on an after-tax basis. Calculate ROAS on an after-tax or post-tax basis. Sir, in our FM, to get an after-tax number, we have a shortcut. What is that? Simply multiply 1 minus tax rate. When you do 1 minus tax rate, automatically you get after-tax. Now, if you have to calculate ROAS on an after-tax basis, refine the formula, don't look at the screen. ROAS on an after-tax basis you need to calculate. EBIT you will take, or EBIT into 1 minus tax rate. EBIT into 1 minus tax rate divided by capital employed into 100. That's it. So check the question, what they've asked, accordingly do it. Sir, if they don't mention whether ROAS is on a pre-tax basis or a post-tax basis, I say in some problems what they do is they calculate both. They calculate both. Let examiner choose whatever they want. If they mention pre-tax, do it on pre-tax. If they mention on an after-tax or post-tax, means use this. If they don't mention anything, calculate of both. Let examiner choose whatever they want to be on the safer side. Alright, this is done. Next is what's a return on equity. Return on equity. Tell the numerator. Sir, is EBA, return on equity means we are talking about return for equity shareholder. Is EBIT available for equity shareholder or what is available? Each. That means tell me the formula for ROE. For ROAS, it was EBIT divided by capital employed. For return on equity, instead of EBIT, what you will take? Instead of EBIT, you will take each, or also known as net income. Divided by denominator, you will take total capital employed or equity. Equity. How do you calculate equity? Equity share capital plus reserves in surplus. Another name is net worth. Okay. This way you will do, you will get the return. So return is always expressed in percentage, hence we multiplied by 100 finally. Next one. Okay. Next is EPS. This you already know, sir. How do you calculate EPS? Each divided by number of equity shares. Next, dividend per share. Dividend per share. How do you get dividend per share? Take the total dividend and divide by the total number of equity shares. You will get the dividend per share. Okay. Next is payout ratio. Sir, whenever payout comes, payout ratio is always expressed on EPS. Payout ratio is always expressed on EPS. So if they say in the question dividend payout ratio is 40%, it means what? If they say dividend payout ratio is 40%, it means what? 40% of EPS company is planning to distribute as a dividend. That's what it is. Payout ratio is always expressed on sales. Okay. Now tell me, sir, how do you calculate this dividend payout ratio? Payout ratio is always expressed on EPS. Hence, dividend payout ratio is given by the formula DPS divided by EPS. Okay. If you want it on a, you can calculate this on a per share basis, or you can also use total also. If you want, you can calculate dividend payout ratio in another way also. Total dividend divided by total earnings. You will get the same answer. Or you can take dividend per share divided by earnings per share. It's a very simple. Here, just check. So let's say company has earned a EPS of 10 rupees. EPS is how much? 10 rupees. Company gave a dividend of 4 rupees. So how much percentage of earnings has the company given? 4 divided by 10 into 100, if you do, automatically you will get 40%. So that's how you calculate dividend payout ratio. DPS divided by EPS. Carry on. Alright. Next one is price earning ratio. Again, this we have already applied. In name only there is formula. Price earning ratio given by the formula MPS divided by EPS. Awesome. Yield. Next is yield. A simple way to remember, yield means market price. When an yield comes in the ratio, yield is a number always expressed on market price. So when yield comes, MPS will always be in the denominator. Whichever yield ratio comes in, market price per share will be in the denominator. A quick fix. Now tell me, that way you tell me the formula for dividend yield. What is the dividend yield ka formula? Dividend per share divided by market price per share. Okay, or the sir, dividend is a return for shareholder. Do you agree? Dividend is a return for a shareholder. Let us say, sir, you will get dividend. Sir, any Tom, Dick and Harry will get dividend, or you need to have that share? No, okay. What's your name, Acha? Huh? Saran. Saran, you have Reliance ka shares, sir? Okay. Sir, Saran doesn't own Reliance ka shares. Will he get Reliance ka dividend? No. If Saran has to get dividend for Reliance, means first he need to buy Reliance ka shares. Let us say he paid 100 rupees and he purchased Reliance ka shares. And Reliance gave him a dividend of 5 rupees. Reliance gave him a dividend of 5 rupees. Tell me, how much is the return for Saran? Return for Saran. How much did Saran invest? 100 rupees. How much money he got? 5. I mean, what is the return he is getting? He invested 5 rupees in the current year and he got back from the company how much? 5 rupees. So how much return? 5%. That's only we call it as a dividend yield. Dividend yield given by the formula DPS divided by NPS. Similarly, you calculate earnings yield for me. What is earnings yield ka formula? EPS divided by MPS. For any yield, MPS will come in the denominator for easy remembrance sake. Okay, you have a macha, you keep it. Great. Next is market value book value ratio. Name itself, there is a formula. Market value book value ratio given by the formula market value per share divided by book value per share. Okay. Sir, in the books, will we present the data on market value terms or historical cost terms. You have all done the accounting. You have all done the accounting. Sir, if you purchase land for 10 lakh, how much will you show the land at? 10 lakh. But its market value may be 10 crore. You have purchased it for how much? 10 lakh. That means you are showing that land in your books at 10 lakh. But its market value after 3 years may be 10 crore also. But in our books, you will show what value? 10 lakh. That is your book value per share. Using your financial statements, we will calculate book value per share. But using market data, we will calculate market value per share. Market value per share, you can take it as stock market price. Book value per share is nothing but your if you remember amalgamation, we have calculated net asset per share. If you remember advanced accounting, that you can call it as book value per share. Anyway, those are not much relevant over here. So this is how you calculate. This is more relevant for public sector companies. Okay, I think let's not go into too much of that. It's not much relevant for examination. Okay, now calculation is good enough. Next one is Q ratio. Q ratio, not that very important, but quickly we'll run through. Q ratio is given by the formula market value of equity and liabilities divided by replacement cost of asset. Sir, at some point of time, every asset you have to replace. Now we have purchased this iPad and all. Will it come forever? No. After 3 years or 4 years, we have to sell this and buy a new one. We have to replace this. For that, we need money. How will we get the money from? Either by issuing equity shares or by issuing debt. That is what Q ratio is trying to calculate. What is the market value of equity and liabilities versus what is the replacement cost of assets? Okay, so that is given by Q ratio. What is Q ratio's ka hypothesis or analysis is? This is the analysis point. I think once they had asked this. If Q ratio is 1, if you calculated Q ratio, if you get exactly 1, then we say share is the stock market ka or the share is fairly priced. Share is not overvalued nor it is not undervalued. It is fairly priced. If Q ratio is greater than 1, we say shares are overvalued. If Q ratio is less than 1, we say shares are undervalued. This is a significance. Just know as an MCQ question 1 or 2 marks by chance if they ask. Doubtful it will get targeted in bigger question, but anyways. Carry on, G. Okay, this is Q ratio. Next is the dew point model. Dew point model is like this. Normally, sir, you eat like this. Dew point model is eating like this. Calculating the same way, but through a weird route. That's all. That's all is dew point model. Okay. Sir, you can calculate rows using dew point model. Sir, what is the normal formula for rows you tell? Rows you know. EBIT divided by capital employed. Okay, no. Our dew point, sir, no, doesn't like this. He doesn't like going straight. You're like, no, I will go like this, sir. Okay, so as per dew point model, rows is given by the formula operating profit multiplied by capital turnover ratio. Operating profit multiplied by capital turnover ratio. Do it. How do you get? What do you call it as operating profit? EBIT. So operating profit ka or how do you calculate operating profit? EBIT divided by sales. How do you calculate capital turnover ratio? Sales divided by capital employed. Sir, this sales will get cut. What remains? EBIT divided by capital employed. What is the formula to calculate rows? EBIT by capital employed. So instead of directly doing this numbers and calculating, you are using these two and calculating rows. That is your dew point model. Also popular in examination. 1 or 2 times has come. Okay. So this is how you calculate rows as per the dew point model. Given by what? Operating profit multiplied by capital turnover ratio. Okay. They will give you these two data in the question and ask you to find out rows. Okay. So this data will not be available. These two data will be available. So using this, you need to calculate. Similarly, using dew point model, you can also calculate return on equity. Sir, what is a normal way to calculate return on equity? Is divided by equity, or you can call it as net worth. Yes. So are you going this way? No. You are doing full circus. So as per dew point model, return on equity is given by. Here you used what ratio? Operating profit. Next one, after operating profit, you will get net profit. So here you will use net profit ratio. Okay. Here you use what ratio? Capital turnover ratio. Here you will use asset turnover ratio. So as per your dew point model, return on equity is given by the formula net profit margin multiplied by asset turnover ratio multiplied by equity multiplier. Okay. Now let's calculate. It's okay. No need to freak out. How do you calculate net profit margin? NP divided by sales into 100. Sir, how do you calculate asset turnover ratio? Sales are divided by total assets. Okay, now check, sir. This sales cut. Okay, we need what for our return on equity? We need each and capital employed. So finally, you need to multiply something. That's multiplying something only. We call it as equity multiplier. Now you tell me, how do you calculate equity multiplier? Check the question. Right now we have total assets. We have total assets. For your return on equity, do we need total assets or not required? Not required. That means this as total assets should be there or it should be cancelled. It's there in the denominator. How do you cancel it? You have to put it in the numerator also. Yes, no. But what do we need in the numerator? What do we actually need in the denominator? Equity. So equity multiplier is given by the formula total assets divided by net worth. So this way, if you do, what happens? This total assets will get cut. What remains basically? Net profit divided by equity. So in these sort of problem, net profit means PAT. Net profit means PAT. But in these sort of problem, preference shares will not be there. If preference shares is not there, means PAT and each are same. That way, you will be able to calculate return on equity using dew point model. You will have to remember them because they will give you this particular data in the question. Okay, they will give you that data. So you will not be able to calculate return on equity directly here. You will have to compulsorily use this only and calculate. Again, how do you get return on equity as per dew point model? Net profit margin multiplied by asset turnover ratio multiplied by equity multiplier. If you're getting confused, construct your own formulas. What you need versus what is available. Accordingly, you can construct your own numbers there. Okay, this is also done. Next, I think done. That's it. Over. All the conceptual revision of ratio is done. Now we'll have to dive into the questions. So are we fairly comfortable? Can we move on? So no need for recap of any ratios. We remember. Can we directly go in? It's not necessary to remember everything. Only 8 to 10 ratios, if you remember, in my view, they are sufficient. Okay. But if you want to play it safe, better remember everything. That's all it is. Okay. Now the questions. Questions we will see. Sir, ratio question is like Sudoku. You know Sudoku? You play Sudoku, no? So what do you do there? Try to find the missing numbers. Ratio questions are like that in examination. That's the way usually ratio questions ask. They will give you some data. Some data will be missing. You will have to figure out that missing data, and either they will ask you to calculate the balance sheet. They'll ask you to prepare balance sheet, or they may also ask you to prepare income statement. Usually for leverage, they try to ask the income statement. For ratio, mostly they will ask you to take the help of ratio and construct a balance sheet. That's how. It's a missing information. So everybody will get answer to ratio question. But the only thing is, will you answer within the time? So all these are a little bit of a time wasting questions. Okay. So watch out how much time you are taking. So don't take your own speed time. All right. Then it'll be like paper only go. So watch out. It will waste you some time. Ratio. Some data you may not get it. They will give you 1 or 2 new adjustments here. So be very clear at what time you started and how much time you have allocated. If you're not able to solve within that stipulated time, leave 1 or 2 pages and move forward. At the end when you have time, you can come back. Okay. Because the first priority is completing the paper. First priority, first goal should always be like that. Okay, have that heart. They say, no, be a stone. Right? When it comes to examination, you should be stone-hearted. You should not let feelings and all come between. Oh, yo, I know this question. Another 5 minutes, please, oh, please. Like that, people convince themselves only. Instead of 5 minutes, they take up 15 minutes, 20 minutes, and paper gone. So please be very careful. As I said, no, with respect to time, absolutely in life, there should be no compromise attitude. You should, indirectly I'm telling, tomorrow come on time. Later, please. Okay, online also. Okay, carry on. Now the question part, we will take it up. Check here. From the following information. Of a company prepare a summarized balance sheet. So we'll have to prepare balance sheet. Let's check. They've given net working capital. So how do you get working capital? Current assets minus current liability. So the moment they give you net working capital, now suddenly make your eyes big. They will also give you another related number. They will give you current ratio. Usually this is a popular adjustment. Net working capital and current ratio. This is a good connection question for ratios. Okay. Have they given current ratio? Yes. 2.5. First I'll read out the question. Then they've given bank overdraft, fixed assets to proprietary ratio. Sir, there are 2 ways to calculate proprietary ratio. Bring back my memory. Proprietary ratio means what? how much proprietor fund is used by total assets. Proprietary, who is a proprietor? Only equity shareholder or also preference shareholder? Proprietor means owner. Hence, proprietary ratio ka one way of calculating is equity share capital plus reserves in surplus plus preference share capital. This is from the equity liability side. We can also work from the asset side. What is our asset side? Fixed assets plus net working capital minus long-term debt. That's another way to calculate proprietary funds. And here net working capital is given to you in the question. So we will take that help and calculate proprietary funds. Done. Then they've given liquid ratio. So these two are also good connection. Current ratio and liquid ratio are good connection. If they've given these two means either you will be able to find out current assets or current liability or stock. Usually closing stock. If they're given these two means, you can take their help and find out closing stock. They are a good connection questions. Okay. These sort of adjustments, these are random, sir. Ratios are absolutely random. Okay. Like this adjustment and this adjustment, they can put it in any ratio question. Alright. So, but usually these two they will collect in some question. They are good connecting questions. Alright. This is the data they have given. We need to prepare balance sheet. So whenever a ratio question is given and balance sheet is being asked, first have balance sheet ka format. Always have balance sheet ka format. And whatever data they have given, first update that. So any balance sheet data currently have they given? Yes, they've given bank overdraft and they've given reserves in surplus. First tick off that. So where is that? Yeah, here bank overdraft is 80,000 and they have given reserves in surplus to be 3,20,000. Done, sir. Okay. One more point in ratio ka balance sheet question you need to remember is, sir, always have an inner column. Always have an inner column. Meaning, sir, all the components of current liability first you write in the inner column. Total you write it in the outer column. This will help you to figure out some missing components faster. All the components first you write in the inner column. Total current liabilities you push it to the outer column. Same way, all the current assets first you write in the inner column. Total current assets you push it to the outer column. Why you do this? I'll tell you in first when I do 2-3 adjustments here. Can we do? So far are we good? These are the two things. Do not forget it. First have the format, and in that format all the components first you show, especially current assets and current liability. First write it in the inner column. Total you push it to the outer column. Do not forget this. This is very important. Otherwise you will go on in loop because few things you'll never be able to find out them unless you do this number. Okay. Okay. Let's start. First, they've given net working capital. How much is net working capital, sir? 4,80,000. They've given you current ratio. How much is that? 2.5. Remember that. So how do you get current ratio? Quickly tell. Current assets divided by current liability. This is given to be how much? 2.5. Okay, let's substitute this now then. Current ratio is 2.5. So current assets divided by current liability is 2.5. That means can I say current asset is 2.5 times of current liability? Correct. Okay. Next, they give you net working capital. How much is net working capital given in the question? 480. So how do you calculate net working capital? Current assets minus current liability is 480. Now instead of current asset, I will substitute. What is current asset? 2.5. So instead of current assets, I'll write 2.5 times current liability minus current liability is 480. Now with this, you will be able to solve current liability this way. That's the reason I said current ratio and net working capital are good connections. Okay, Saru? If you know current liability, automatically you know current asset. How much is current asset? 2.5 times of that, which is 8. Now you got total current assets and you got total current liability. Inner column or outer column? Outer column. Total current liability, how much? 320. Yes. Similarly, what is the total current assets? 8 lakh. Got it, everybody? Okay. Sir, if you just check the question, okay, have they given you any data? Sir, what are some of the examples of current liability? Can you tell me? Some of the common examples or components of current liability. Creditors, bills payable, outstanding expense, bank overdraft and all. In this problem, they've given bank overdraft. They've given bank overdraft. Bank overdraft is definitely current liability. Other than that, any reference to creditor, outstanding expense, blah, blah? No. So hence what we will do is, what is the total current liability? Just now we got 320. In that 320, how much is bank overdraft? 80. Okay. And balance is others, 240. Arrived as a balancing figure. That's the reason I said always have an inner column. This way you'll be able to figure out the things. If we have given no data means, then this is others arrived as a balancing figure. Basically 320 minus 80 will give you 2,40,000. What are others? Could be creditors, bills payable, outstanding expense. Don't know. So can we prepare balance sheet on a balancing figure? Sir, in the ratio chapter, no, we are preparing balance sheet on a summarized basis. This is not actual balance sheet company will prepare. Sir, will company prepare balance sheet in this format or schedule 3 format? Schedule 3. So ratio is just that to the extent possible you will prepare balance sheet. And other components you can get it as a balancing figure. That is okay because this is a summarized balance sheet. Good so far? Same way current assets. What is the total current assets? 8 lakh. 8 lakh we have got it. But do we have any components of current assets or not yet? Not yet. So let this be on hold. Till now we have got this to be 8 lakh. Okay, move on. Next. Sir, do you know current ratio? Yes. Do you know quick ratio? Do you know quick ratio? Yes. We just now said. Here it was given. No? Correct. Current ratio was given and also quick ratio is given. So I told you, sir, these two are again a good connection. You'll be able to use this information either to find a current asset or to find current liability or to find closing stock. Current asset, current liability have to find or already found. That means in this problem, we'll use these two connections to find out closing stock. How? Let's see. Okay. Sir, how do you calculate quick ratio? Tell me the formula. Quick ratio, how do you calculate? Current assets minus closing stock divided by current liability. That quick ratio is given to be 1.5. So current assets minus closing stock divided by current liability is equal to 1.5. Current assets ka value you know, current liability ka value you know, only closing stock data is missing. So when you solve this equation, automatically you will get closing stock to be 3,20,000. That's all. Okay, sir? Because current assets you know, current liability also you know. Only component missing is closing stock. Should I have to solve it or fine? Fair enough, everybody? So closing stock value is how much? 3,20,000. So what is the total current assets? 8 lakh. In this, we got one component of current asset, which is how much? Closing stock, 3,20,000. About debtors and all, have they given breakup or no breakup? Total current assets is 8 lakh. In that, if 320 is closing stock, means balance is other current assets arrived as a balancing figure. 4,80,000. That's all. This way, the current asset portion is fully done. Carry forward to the next one. Next, they gave proprietary funds. Correct? Something about proprietary funds they told? No, here. Fixed assets to proprietary fund is how much? 0.75. Let's use this information. They told fixed assets to proprietary funds. If you do fixed assets divided by proprietary funds, the question is saying it is 0.75. That means, can I say fixed asset is 0.5 times of proprietary fund? Okay, G. This I did not calculate. They gave in the question. Okay, fixed assets to proprietary ratio they gave. So fixed assets divided by proprietary funds, if I do, you should get 0.75. Therefore, fixed asset constitutes 0.5 times of proprietary funds. Done? Okay. Now let's try to calculate proprietary funds. There are two ways to calculate proprietary funds. Proprietary funds means owners' funds. Who are the owners? Shareholders. Who are the shareholders? Equity and preference shareholders. Keep that in mind and tell me how do you get proprietary funds? Proprietary funds is given by the formula. Equity share capital plus reserves and surplus plus preference share capital. That is one way. Okay, you can do equity share capital plus reserves and surplus plus preference share capital. Sir, in this problem, equity share capital, do you know? Missing. Reserves and surplus, do you know? Yes. Okay. Preference share capital, do you know? Yes. That also you don't, right? That means data is missing. Let's use the other formula to calculate proprietary fund. What is one more formula to calculate proprietary fund? That's from the asset side, which is fixed asset plus net working capital minus debt, minus long-term debt. Now, this is how you get proprietary fund. I'm calling proprietary fund as PF. So instead of fixed asset, I will substitute. What is fixed asset? 0.75 of proprietary fund. So proprietary fund is equal to 0.5 times of proprietary fund plus net working capital. Net working capital is missing in the question or given in the question. How much was net working capital as per the question? 4 lakh 80. Debt, no information, so we'll take it as 0. So using this, you'll be able to calculate proprietary fund. When you substitute, you'll get proprietary funds to be 19 lakh 20,000. That's how you calculate proprietary funds. Need a minute? All okay. One way to calculate proprietary fund is this. Another way is this. Okay, G. If you want, I can prove this also. I proved it also in regular class. 2 minutes. If you want, I'll spend this also. Sir, this is the assumption. Just for your reference. This is the balance sheet data. Calculate proprietary funds for me till 0.5. That proprietary fund will be to use. Done, G. So 75 times of that, which will be how much? 14 lakh 40,000. So you can go ahead and fill fixed asset in your balance sheet. Fixed asset is 14 lakh 20,000. Done, G. Fixed asset, you know. Total current assets, you know. That means you know the total asset side balance sheet, which is 22 lakh 40,000. Balance sheet always matches. Even if we don't match, we will match it somehow. Correct? No. If liability is 22.4 or asset is 22.4, means liability also should be 22.4. Correct, people? Now balancing figure. That's all. What is that? Sir, 22 lakh 40,000 is a total. In this, 3.2 is a current liability. Long-term debt, not there. Preferential capital, not there. No information. Reserves and surplus is given. Reserves and surplus is given. Sir, when you add all this compulsory, you should get 22 lakh 40,000. Take a calculator. 22.4 minus 320 minus 320. 22 lakh 40,000 minus 320 minus 320. How much is that? 16 lakh. That is equity shares capital arrived as a balancing figure. You can arrive it as balancing figure or prepare a working note like this also. Your choice. Done, people? Oh, yes. Or another way to calculate. If you don't like this approach, you can use another approach. So how do you calculate proprietary funds? Or how do you calculate proprietary funds? Normal formula. Equity share capital, reserves and surplus, and preferential capital. Should we have to find proprietary fund or already worked? How much is that? 19 lakh 20,000. Equity share capital, we don't know. Reserves and surplus is given in the question to be 320. Preferential capital, no data, so it is taken as 0. Now, only thing missing in this problem is what? Equity share capital. Solve this equation, you'll get equity share capital to be 16 lakh. Either you can prepare a working note or directly get equity share capital as a balancing figure. Your choice. This is how to figure out. Tell me, is this something I have to teach you or you can figure out all this? You can all do this on your own. It is just that, will you do it within that? Like, if this question by chance comes for 7 marks, maximum in my view, 15 minutes, not more than that. 20. Just looking at your face and saying, Papa, okay, 20. Beyond that, danger zone. Ideally 15. Okay, maximum 20. Beyond that, I personally feel you are not in the right type of things. Okay, so that's things. All this will, again, as I said, it will come with practice. Okay, so how to do it? Some common connections, whatever they use, I'll keep telling you so that you can use as a memory. But 1 or 2 new connections will be established. So ratio questions are meant, I say, it gives ratio questions to waste your time. In ratio question, because since it is fill in the blanks wala question or finding a missing figure question, many students won't get it immediately. They will waste 5 to 10 minutes. So the ratio questions are meant like that. So always take up the ratio questions ideally. If you see any new adjustment, anyway, first 15 minutes you'll get to read the paper. So read the question. By chance, if you feel ratio questions is pretty straightforward, you're comfortable, means take it up. If you find any new adjustment, ideally I would suggest take up all this question at the end. Finish all the questions. Always the first priority is solve those questions which you feel you're confident about first. New questions you take it later based on availability of time. So this way you'll not waste time. Done. So this question is done from my end. Waiting on next thing. Paka, 1 or 2 more I will take it up and then we will like call it a quit for this particular question. Okay, next question. G. What is next question? Online also there, people still. Is that a mosquito or a spider? Looks quite big. Mosquito means, oh, daivo me. Okay, now all our attention will be there only. Correct now? Yeah. Now we are with you, sir. Sir, will you take investment decision today? Yes, much I will take that. You don't want me to take it, Sir, today's topic, what and all you'll cover, you tell. No, I told you yesterday only, Ratio, investment decision, and dividend decisions. Those are the scope for today's session. Working capital tomorrow. RTP, MTP tomorrow. Now, Shata. Following information relates to Temer Limited. I think this is a study material question or, I don't know, previous year paper question. I don't remember. Study material question only. Awesome. Debtors velocity group. You know debtors velocity. Sir, if you know debtors velocity, you can find out debtors turnover ratio. If you know debtors turnover ratio, you can find out debtors velocity. That way, how do you calculate debtors velocity? First tell me. Debtors velocity is given by 12. Sir, they've given the data in months. In a year, there are how many months? 12. So debtors velocity is given by the formula 12 divided by DTR. So using debtors velocity here, you can find out debtors turnover ratio. Okay, if required. Okay, we'll see. Similarly, they've also given creditors velocity. Using creditors velocity, you can calculate creditors turnover ratio. Basically, 12 divided by 2 you'll have to do. That way, you'll get creditors turnover ratio to be 6. Then they've given stock turnover ratio. So stock turnover ratio is a formula, or you can call it a stock turnover ratio or inventory turnover ratio. What's the formula? COGS divided by average stock or closing stock. If average is the first priority, if average is missing, then we'll go for closing stock. GP is 25%, and then they express it is always 25% of sales. So okay, so GP is 25% of sales. Then bill receivable. They gave bill receivable. Sir, your debtor turnover ratio uses debtors or it uses accounts receivable? Accounts receivable. Accounts receivable means debtors and bill receivable put together. Keep that in mind. In this problem, BR and DP are there. So be careful when you calculate debtors turnover ratio and creditors turnover ratio here. This one. Then good thing, they have given GP. They have given GP. And they have given fixed asset turnover ratio to be 4. Closing stock for the period is 10,000 above opening stock. So that means they have given some information about closing stock and opening stock. So if they have given some information about opening and closing stock means average stock information missing or given? Given. So for inventory turnover ratio, we should take now closing stock or average stock. If they give you average stock directly, take average stock for calculating stock turnover ratio. Or if they give some information about average stock, you should always prefer average stock. If nothing is mentioned, if the sentence was not there, that means information is completely missing. In that case, you will take closing stock to calculate inventory turnover ratio or stock turnover ratio. How to start? Can you read this question and tell me how do you proceed? Don't look at your solution or study material or anywhere. Looking at this data, tell me how do you start. If suppose this question comes in your examination, you can find out sales. Perfect. How? Sir, GP is 25% of sales. GP you know. That means using these two connections, you can find out sales. Then, sir, if GP is 25% of sales means COGS will be 75% of sales because sales minus COGS only is your GP, no? Correct? So if GP is 25% means, COGS is 75% of sales. The moment you know sales, you can find out COGS. The moment you know COGS, you can find out inventory turnover ratio. You can use and find out average stock. Then you can use this information to find out opening stock and closing stock. Correct? Now, fixed asset turnover ratio is given. Sales you know means fixed asset also you can find out. Okay, sir? Right? The moment you know sales means using sales, you can also find out debtors. You can also find debtors. That's how the connection. If you are able to figure out this connection faster, then you'll be able to solve the ratio question within the time. If you get stuck in figuring out things, then you will take 5 or 10 minutes extra. You'll get it, but you'll take 5 or 10 minutes extra. So watch out for the time. Alright, so let's calculate the things over here. So quickly tell sir, how much is GP? 4 lakh. What is GP percentage on sales? 25%. Let's take it up. Here. GP amount is given as 4 lakh and GP they told in the question is 25% of sales. So therefore sales is what, sir? GP divided by 25%. 4 lakh divided by 25% if you do sales is how much? 16 lakh. Got it? If GP is 25% of sales means COGS will be 75% of sales. 16 lakh or 75% if you do, you'll get COGS. Okay, in fact, we didn't read the requirement of the question. What did they ask in the question? Watch out. Sometimes they ask weird things. They ask sales and COGS. Luckily, we already found that already. Great. Then they ask debtors, creditors, closing stock and these are not balance sheet questions. You just need to find out these 5 or 6 missing components. Okay, sales and COGS we already did. Okay. Next, sir, they're asking now the debtors. Can we calculate debtors? Okay. There are multiple ways here. I'll show you both. According to me, there could be more also. The way I could think of, I say there are 2 ways I could finding the value of the debtors. You figure out what is comfortable for you. Okay. Sir, do you know sales? Do you know sales? Yes. Sir, if they don't give you the information, always take the total sales and credit sales is same. If they don't give you any cash sales information, the 16 lakh is what, sir? Total sales. The total sales and credit sale we always assume to be same. If cash sale is there in the question means they will clearly mention. If it is not mentioned, then all the sales are made on a credit basis is the assumption. Okay, sir? And debtors you will get it on what sales? Credit sales. Yes? Okay, very simple. Sir, what is a sales? 16 lakh. This 16 lakh is 1 day ka sale or whole year ka? Whole year. And if you read the question, they gave you the data in days, weeks or months. Months. I'll show it you once again. They gave you the data in months. Check what did they tell you. Come down. Here. Debtors velocity is how much? 3 months. Stop. Debtors velocity means what? Debtors velocity means debtors ka credit period. How much credit period are you giving to debtors? On an average, how much credit are you giving to your customers or debtors? 3 months. Okay. And okay, now come back to the question. How much is the sales? Just now we got sales to be how much? 16 lakh. 16 lakh is the sales for 12 months. Sir, are you giving 12 months credit to your debtors or only 3 months? How is this 3 months? They only told in the problem debtors velocity is 3 months. Debtors velocity means credit period. So for 12 months, the value is 16 lakh. Are you giving 12 months credit to your debtors or only 3 months? For 3 months, how much is the value? Find out. Just as a proration. Okay, this is one way. So when you calculate X, what it will be? Cross multiplication. 16 lakh into 3 divided by 12. If you do that, you will get 4 lakh. Mind you, this is not debtor. This is accounts receivable. This is accounts receivable. Because in this problem, they have given bill receivable. Okay, sir? So total account receivable is how much? 4 lakh. Total accounts receivable is 4 lakh. Sir, in this, how do you get accounts receivable? Debtors plus bill receivable put together. Sir, accounts receivable is 4 lakh. Debtors you don't know, but bill receivable is given in the question to be 25,000. They give. You can trust me on that. Yes, no? Yes. So bill receivable is 25 and total account receivable is 4 lakh. How do you calculate debtors here? These two come minus and debtors will give you 3,75,000. This is one way to calculate, one easy way to calculate debtors. Done, sir. If you don't like this approach, you can use formula. What is that? Sir, if they give you debtors turnover ratio, if they give you debtors velocity, using debtors velocity, can you calculate debtors turnover ratio? How do you calculate debtors velocity? Tell me. Debtors velocity, how do you calculate? 12 divided by DTR. 12 divided by DTR. Data, that means if you have to find out DTR, what will you do? 12 divided by debtors velocity. Works both ways. So 12 is constant. Debtors velocity is given in the question to be 3. That means debtors turnover ratio is how much? Using debtors velocity, you got debtors turnover ratio to be 4. Okay. So far good, everybody? Sir, what is the formula to calculate debtors turnover ratio? Tell me. Debtors turnover ratio. Any turnover ratio, the formula is sales in the denominator. Which sales? Total sales or credit sales? Here anyway total sales is assumed to be credit sales. I mean the formula is annual credit sales divided by, not debtors, divided by average accounts receivable. Have they given you account receivable opening and closing balance? No. That means you will take closing balance of accounts receivable. This is the formula. Debtors turnover ratio, you already got it to be 4. Annual credit sales, you already got it to be 16 lakh. Therefore accounts receivable is how much? 4 lakh. You got how much in the previous method? 4 lakh. You can choose whatever method. Okay. Now accounts receivable, how do you calculate? Accounts receivable is nothing but debtors and bill receivable put together. Okay. In this 4 lakh, if bill receivable is 25,000, means debtor will be 3 lakh 75,000. Manageable. One new present, I've just shown both for your reference. Whichever works for you. If you are a believer in formula, you can go for this method. Or if you feel this is workable, we can use this method also. I prefer this because you don't have to remember any formulas. You can directly get it. That's how debtors we got it. Okay, G. Alright. Next, they asked, I think, third step, what did they ask? I think here somewhere I've written. Third one. Creditors they asked. Okay, creditors, let's calculate. Fine. Sir, okay, what is creditors turnover ratio? They've given you creditors velocity, right? Is it okay if I stick to this method? That's okay with your proration. You can also use formula method. That you can choose. I think I'm here for the creditors. I've only done this method, I think, in the interest of time. Okay. Sir, tell me, creditors will, what is the formula for creditors turnover ratio? Annual credit purchases. Stress on that word. Annual credit purchases divided by average accounts payable. If not, if average is missing, then you'll take closing balance of accounts payable. Correct? Okay. For creditors, we need annual credit purchases. Is that given or missing? Missing. Okay. Sir, there is a way to calculate credit purchase through COGS. Tell me what is the formula to calculate COGS? How do you calculate COGS? Cost of goods sold? One is okay. Sales minus GP. Leave that. Normal way, tell me. COGS. Cost of goods sold. Opening stock plus purchases minus closing stock. Sir, if you know opening stock, if you know closing stock, if you know COGS, can you find out purchases? Yes. Means to calculate creditor, first we need to know opening stock and closing stock. Okay. Opening stock and closing stock, which information considers? Stock turnover ratio. So first we will solve stock turnover ratio. Okay, G. So we'll take this way. So inventory turnover ratio or stock turnover ratio is given in the formula in the question to be 1.5. This is given, right? What is the formula to calculate inventory turnover ratio? COGS divided by average stock. So should we take average stock here or closing stock? In this problem, they mentioned in the question that closing stock is 10,000 more than opening stock. So if closing stock and opening stock data is mentioned, means obviously we need to take average stock. COGS, do you know? Yes, COGS we already found to be 12 lakh. So 12 lakh is your numerator. Average stock we don't know is equal to 1.5. So solve this. Average stock you'll get it to be 8 lakh. Done, sir. So how do you calculate average stock? What is the way to calculate simple average? Or average stock is given by the formula opening stock plus closing stock divided by 2. Average stock, just now we got it to be 8 lakh. Opening stock, let it be as it is. They told in the problem, they mentioned that clearly that closing stock is 10,000 more than opening stock. I'm not saying, question where they told, we did this, yes. Closing stock is 10,000 more than opening stock. So if opening stock is 50,000 means closing stock will be 10,000 more, which is 60,000. Let opening stock be OS. You can assume some variable also, X or A. I'm just taking it as OS. If opening stock is OS means closing stock will be OS plus 10,000, correct? Correct. So that's what I'm substituting. So instead of closing stock, you write opening stock plus 10,000. Now solve this equation. When you solve, you'll get opening stock to be 7,95,000. Correct? I hope I don't have to waste my time in solving now. That is okay. So opening stock is 795 means closing stock will be how much? 10,000 more, which will be how much? 8,05,000. Okay, G. Cool. Now you know opening stock also. You know closing stock also. You know COGS also. That means can we find purchases? Yeah. That means now we can go for creditors. For creditors finding out, we need annual credit purchase. Through that credit purchase, we'll get it with the help of COGS equation. COGS is given by opening stock plus purchases minus closing stock. COGS we already got it to be 12 lakh. Opening stock just now we got it 795. Closing stock just now we got it 805. Purchases is missing. So use this equation to find missing purchases of how much? 12 lakh. 10,000. Easy, people. Doubt or okay? This 12 lakh 10,000 is one day purchases or whole year? This 12 lakh 10,000 is purchases for the whole year. So they have given you creditors velocity in the question. Check how much is creditors velocity. Creditors velocity means how much credit period are we getting from creditors. If you buy the goods from creditor today, will you pay today or after 2 months? After 2 months, because creditors velocity or creditors ka payment period is 2 months. Okay. Come back to the question. How much is the purchases? 12 lakh 10,000. 12 lakh 10,000 is the value for 12 months. Are you getting 12 months credit from your creditors or only 2 months? For 2 months, how much is the value? Find out that. When you prorate, x is equal to what? 12 lakh 10,000 into 2 divided by 12. If you do that, you'll get it to be how much? 2 lakh 1,667. So is this creditor or accounts payable? This is accounts payable. Okay, G. If you don't want this one, you can go another way. What is another way? Using creditors velocity, you can find out creditors ka turnover ratio. And then apply creditors ka turnover ratio ka formula. Creditors turnover ratio is given by the formula. Annual credit purchases are divided by accounts payable. That way you will get accounts payable. Okay? Or you can directly get it like this. How much is accounts payable? 201,667. What put together we call it as accounts payable? Creditors plus bills payable, if you add up, you will get accounts payable. Accounts payable, we have got it. Bills payable is given in the question to be 10,000. That means your creditors will be missing. So which is how much? 201 minus 10,000 if you do, you'll get 191,667. That's it. Done, sir. Alright. Next, they asked you to find out fixed asset. And they give you fixed asset turnover ratio they have given in the question. How much? 4. Sir, what is the formula? This is given. Fixed asset turnover ratio is 4 is mentioned in the question. What is the formula to calculate fixed asset turnover ratio? Sales divided by fixed asset is equal to how much? 4. Sales you already know. How much is that? 16 lakh. Fixed assets you don't know. This should be equal to 4. When you solve this equation, you will get fixed asset to be 4 lakh. This is how they establish the connection. That's what I think all the requirements we have solved. Need some time to review or next question? No, maybe one. FCA. But I hope everyone knows what